Hey everyone, me Kevin here. In this video, we're going to talk about exactly how much real estate prices are going to fall in the future. Now, you might think it's crazy. Wait, how can we determine how much home prices are going to fall? Well, I'm going to show you with a rule of thumb in this video and some new insight that we just got yesterday. And this is very important. But first, we've got to look at something that is becoming an inflection point in real estate right now. And it has to do with slowing down home sales and slowing down price appreciation. Now, this is not necessarily a bad thing. This is something that you would hope and is actually something that is natural around this time of year. In fact, let's start there. Let's start at the Redfin data center. It's very normal that after the summer, we get a slowdown in the amount of new listings, especially as children go back to school. The red line here is 2020, which I think is a little bit of a weird year, we should say. But otherwise, you see here in 2019 and 18, a consistent downtrend right around the time that school starts in terms of new listings. But what we also want to keep an eye on are median sale prices. And here, what you'll notice is around this time of year, you usually have a moderation in prices or a decline in prices. And that's exactly what we're seeing here ever so slightly. The median home price sort of peaked around $361,000, and we're down just about 1% to about $358,000. At the same, so in other words, good to sort of take a little checkpoint there and mention, we got less properties being listed, and the properties that are selling are starting to sell for a little bit less, even though less are coming on the market, which oftentimes has been associated with, well, if less listings are coming up on the market, that means more of a supply crunch, right? But if we've got less listings coming on the market and we're seeing a little bit of a slowdown in pricing, then that's generally a consistent sign that prices are softening a bit. We do see the same thing here in pending sales. Would make sense that pending sales would rotate down around this time of year, so this is pretty natural. Most important one to pay attention to here is the slight inflection point in this moderating of prices. We're not consistently going to the moon anymore like we were really since, January of this year and much of the end of last year. We saw a good bump as well, with the exception of really November, December, when real estate does often also slow down. Okay, so what does this have to do with the future? Well, in addition to seeing this sort of moderating in prices here on the Redfin data center or in articles such as this one from Reuters, which mentions that this is as of September 22nd, so this is a yesterday article. Don't worry, this information you're going to get in this video is still going to be timely, even if you watch this in the future. But it does say here, existing home sales fell 2% in August, housing inventories declined 13.4% from a year ago, and median home prices increased. They're still up 14.9% from a year ago, but we're starting to see that inflection point, right? See, the report from the National Association of Realtors Wednesday showed the smallest share of first-time homebuyers in more than 2.5 years. And we are seeing a moderation in existing home sales, reflecting some easing of the buyer frenzy. Okay, this makes sense. So what does this have to do with prices in the future? And how do we calculate how much real estate prices could potentially fall in the future? All right, let's answer both of those questions. So the first one that I'm going to tackle is I'm going to give you information that's going to help you recognize, okay, so this is where we're potentially going to get some softness in the real estate market. It has to do with interest rates and bonds. So mortgage rates in real estate are at record lows right now. But when the 10-year Treasury bond rotates to the upside, mortgage rates tend to go to the upside. And we had a little bit of what we're calling a delayed taper tantrum. The Federal Reserve said on Wednesday that they do not expect to start tapering or reducing support for the economy until November. But then at the end of next year, they're going to increase interest rates. And even though we're not going to see that interest rate increase until the end of next year, we're starting to see that movement in the Treasury market already. This is the 10-year Treasury market right here. This is what it looks like. And you can see on this 1-month chart here that we're peaking at the highest level here in the last 1-month chart. I'll remove myself for a moment here at about 1.43%. Now, we've been much higher as inflation fears were higher in earlier parts of the year. And so you can see we're really just starting to finally trend back up. But watching this is going to be a big indicator because mortgage rates will rise. And as mortgage rates rise, home affordability goes down. Now, that is a very, very important piece of the puzzle right here. And that helps us understand how much real estate prices could come down. So what else do we know as in terms of why we're starting to see this spike here in the 10-year Treasury market? Why are we seeing this again? And why did real estate prices not collapse earlier in the year when the 10-year Treasury yield was higher? Well, very good questions that I kind of just asked myself. This particular rise here in 10-year Treasury yields is worth noting was a very temporary cause. This was based on fears of inflation, not longer-term fears of rates going up. And so this was mostly a movement that impacted the stock market, specifically tech-related stocks or Cathie Wood-style stocks. This over here is, in my opinion, less concerning right now to the stock market and more concerning to the real estate market. And the reason it is because of this here from the Federal Reserve. Now, this is a little bit messy, so I'm going to erase this a little bit, and we're going to clean this up together. Right here, the Federal Reserve is projecting that interest rates will have their first increase of about 1/4% in the second half of next year. That's what this change from basically 0 to 0.3 means. And you can see right here, these are the dates. So I'll do a quick little cleanup right here. There you go. You got the dates here, 2022, 2023, 2024, right? Previously, we didn't have projections for 2024. We had nothing here. We had 0.6 here for 23, and we had no increase for 2022. Now, we're expecting to see an increase in rates in the second half, or 2H we call that, second half of 2022, and then another 2 rate increases in 2022, and then more rate increases in 2023. So, what can we now expect in terms of real estate prices, and how quickly do these change here? Well, let me show you that really quickly. But first, quick note, if you like the information in this video, consider checking out my programs on real estate investing, do-it-yourself property management, or real estate agent sales. There are also other programs. I'm making YouTube videos and stocks, linked down below, but these 3 are very, very popular for real estate investors because you get all of my experience as a real estate broker, real estate lender, contractor, property manager, and real estate investor, all combined in these programs. So that way when you're negotiating deals, you're negotiating loans, you're doing refinances, you have questions, whatever, these programs are your encyclopedia to building wealth with real estate. Check those out, link down below. There is a coupon code that is expiring Friday. It is in the description down below, and then pricing will be going up. To understand sort of the Federal Reserve's rates, and this isn't so terribly important, but I'll go through it really quickly. This is where we sit right now with rates at the Fed. These are different from mortgage rates. 10-year Treasury rates are different from mortgage rates as well. They just tend to go in the same direction. Well, after we get our first bump, we'll be at 0.25 to 0.5. So this is going to be what we expect to see in the second half of 2022. Then we're going to see 0.75 to, we're going to see 0.5 to 0.75. This is going to be 2023, 0.75 to a 1, 23 right here. And then we might see an additional 3 rate increases here in 2024. So 2024 might look a lot like 1 to 1.25, 1.25 to 1.5, and then 1.5 to 1.75. This is approximately the sort of schedule of these increases that we're expecting. That's at the Federal Reserve. This is going to push up the 10-year Treasury yield, or at least that is the expectation. And expectations can get fulfilled by people who trade this market. If people think that this line here is going to go up, then they can short Treasury yields, because as prices go, or short Treasuries that is, because as prices go down in the Treasuries market, which would mean their shorts pay off, yields go up. Okay, the technical part doesn't matter so much. What really matters more is that you know there's a direct connection between what the Federal Reserve is doing, the impact that is going to have on the Treasury market, and then the impact that is going to have on mortgage rates. So let's now take a look at a chart of mortgage rates, and let's do a little bit of calculating so we can kind of see, all right, what do we think is potentially going to happen to those real estate prices over time? All right, so here's a chart of mortgage rates. So you can actually see when those Treasury yields shot up here in February to April, we did see mortgage rates go up. but they were still at record lows, right? Like, who cares? It's 3.13 versus the 2.86 now. Like, big deal, right? That's not that big of a movement. So what is a recent example where I was also making YouTube videos about the Federal Reserve increasing rates and potentially hurting the real estate market because mortgage rates were going up? The answer is 2018. So we're going to jump on over here to a 5-year chart, and we're going to look at 2018, the summer of 2018 specifically. And what we want to do is also pull up the Fed funds rate. We can do Fed Reserve, St. Louis, Fed, there we go. And we're going to go ahead and put this rate chart up next to this. So this here is the Fed funds rate. This is what I was talking to you about, and this is where we sit right now at essentially 0. And you could see the Fed funds rate got regularly pumped, specifically over here, because this is the last time we started really raising rates was in 2016, in 2017, more aggressively in 2018. But the market had a pretty severe reaction in the summer of 2018 going into 2019. And so what happened is the Fed stopped raising rates and then eventually lowered those rates before we even got to the pandemic. When we hit the pandemic, rates went to 0. But the Fed slowed down on their rate increase and then actually reversed before the pandemic because they had gone a little too crazy with raising rates too fast. And over here, you could see that play out in mortgage rates. Mortgage rates went up from 3.83% to at one point a high of over 1% more until, of course, the Fed reversed course. They lowered their rates, they chilled out a little bit, and we saw those mortgage rates come back down. Okay. So how does this affect real estate prices? Well, here's the thing. There's a rule in real estate called the rule of 10x. For every 1% change in a mortgage interest rate, we would expect, and I'm going to spare you the math for doing this, but you can fact check this yourself by using a mortgage calculator and play with the payment. Just remove things like property taxes and insurance and things like that. Just look at principal and interest and change the interest rate by about 1%. And then consider how much of a difference in price you have to change the affordability of that property. Usually, and this is rough, but it's pretty close and tends to be pretty consistent. Usually when rates go up 1% on mortgages, which is obviously pushed up by the Fed funds rate, which pushes up treasury yields, right? Then real estate prices tend to go down by about 10%. So rates go up 1%, prices come down about 10%. When we had that surge of rates about 1% in the real estate market there in the summer of 2018, we saw real estate prices tank about 12% in a matter of 8 weeks. It was crazy. I was actively selling real estate and dealing with that price drop every single day. Like, it was so in my face. But anyway, this 1% increase in rates reduces affordability by 10%. All right, so how do we compare this to what we've got going forward? Well, we'll set this all up to come to this conclusion. Right now, we saw real estate prices do this. Now, we're seeing real estate prices level, which means we might be at a more potentially normal priced real estate market with rates stable where they are at, let's just say, 1% growth per year. Just because we've had this incredible run, let's say we level out at about 1% growth just for the next couple years as people, or maybe even 5 years, who knows? You could have slower real estate appreciation going forward now for the next few years as people start being able to afford pricier homes and actually get into these by their wages going up, their incomes going up, their savings going up, more inventory coming on the market, whatever, right? So let's say we're expecting, to level out for the rest of the year or maybe the next 12 months at something more like a 1% real estate appreciation rate. Or you know what? Let's be generous. Let's call it 3% appreciation rate. Fine. Doesn't matter so much what number we're looking at here. We're trying to figure out how much of a difference we're going to have. So this is what's called your tailwind when you have price appreciation. That's a tailwind, right? That pushes prices up. But now, if the Federal Reserve is going to bump interest rates, we're going to get a headwind. Now, we expect the first bump of about 0.25% to come the second half of 2022. And the last time they raised rates about 0.25% was in 2016. And we could see that right here. You could see this bump from November of 2015 into 2016. Had about that 0.25% bump in the Fed funds rate. That translated over here. Oh, it looks like you need a trial over here to get in past the 5-year chart. Well, we're going to skip that right now. So instead, let's just look at a different bump here. So let's go over here to November 2017. And here we got a different bump. So between November and December of 2017 and 2018, we got about that 0.25% bump. So let's look at 2017 and November of 2017 over here, going into the earlier part of the year, right about here, Feb. Looks like we had roughly a 0.25% bump. Look at that. December over here sitting at about 3.9%. Beginning of the year sitting at closer to, once we get to February, 4.25%. Pretty similar. Had a little bit of flatness before that. It looks like mortgage interest rates were relatively flat here between July and November. And that's kind of what we see here as well. Look at that. July and November, mortgage rates flat. That's kind of what we saw over here as well. This sort of flatness. And it's not always the case that you're going to, because see here, right, you can see between November of 2016 and July of 2017, right here, you had a bump, but a little bit of an overpush. See how quickly mortgage rates spiked up? And then it took them a little longer to come back up. But anyway, the point is, you're probably going to see about that 0.25% mortgage rate increase. Sometimes, though, if the market fears that it's going to be more aggressive, the market might try to start pricing in things a little bit too fast, too early. So you could actually get a worse overcorrection. And that's kind of what you saw here and why you got a little bit of that trickle up or trickle back down here before you move back up again. But anyway, the point is, see about a 0.25% move at the Fed, probably going to correspond to a similar 0.25% move in mortgage interest rates, lest the market gets fearful and rates go up even more, which is possible. Okay, so now let's go back over to the iPad here and translate that. Let's say real estate prices are moving up 3% a year, and now we get our first bump. In the second half of 2022, we get a 0.25% bump. We would expect real estate prices to actually go down 2.5%. Which means we basically roughly eliminate our home price appreciation just with that one bump. Now, as we mentioned on the prior page here, we expect in 2023 2 more bumps. Well, this right here could be representative of an additional 5% decline. But we'll be in 2023, so maybe there'd be another 3% appreciation. We might end up in 2023 with negative 2% real estate pricing. And we get to 2024, if they keep pushing rates and we get another 3 moves there, that would be like a 7.5% headwind minus that 3% a tailwind pushing up prices. We could see a potential 4.5% decline in real estate prices. So this just gives us a quick sort of rubric. Now, the big question is, what is that? And this is the part that we do not know the answer to, okay? We do not know the answer to what this supportive tailwind number is going to be. See, if we draw a sort of a schedule out here in terms of what we just drew, we saw if we're at 3% of an increase per year in, let's say, 22, 23, 24, we do 3% each year here. We saw that we're going to have those potential headwinds of 7.5%, 2.5% here with the one bump, and a minus 5% over here. That would be a roughly net positive over here, but here we'd be losing in pricing, right? That's what we just did. What if, though, because of the eviction crisis and more houses potentially coming on the market, which home listings are slowing down right now, but you've got an eviction crisis, you've got this potential that maybe people think the real estate market has topped and it's time to start offloading some real estate. You've got some other concerns that could come to real estate. What if we don't get that top line movement of home pricing having a 3% tailwind? What if instead of a 3% tailwind, we stayed flat at 0% growth because people are tired of paying the higher prices, or we get more inventory or whatever, we get to a more balanced market, whatever that reason might be? Well, now, if you have no tailwind of 3% appreciation per year, and the Fed's going to raise rates up through about 2024, and then supposedly they got to wait there, then we could actually see real estate prices decline 2.5% in 2022, 5% in 2023, and 7.5% in 2024 until stabilizing again, which would mean a lot of this big run that we had over the last year could go away. So let me give you an example in terms of what this might look like in terms of housing pricing. Hop on over here, do a quick calculator. Let's say prices come down. We don't have any tailwinds at all, no appreciation, 0%. And so housing prices go down 2.5%. That would bring us from $700,000 to $682,000. We come off another 5%. That would bring us down to $648,000. And if we come off another 7.5%, 0.925, there we go. That would bring us down to $599,000. We could literally see a $700,000 house become a $600,000 house again in the next 3 years, solely because of natural action by the federal, well, it's not natural action, but action by the Federal Reserve leading mortgage rates to go up. It's nothing natural about it. And again, the only thing that prevents that is the real estate market having a tailwind, and ideally a stronger tailwind. For example, let's say we had a 4% tailwind. Real estate was expected to appreciate 4%. Well, let's play this out. So real estate goes up 4% in 2022. Now your $700,000 house is $728,000. But we got that 5% headwind. Now we're going down 1% in 2023. And the year after that, we'd be going down, let's say 4% tailwind again. We take off a 3.5% loss, that difference between 7.5 and 3. That's 3.5%, so 965 point. That would bring us down to about $695,000. So you could literally see real estate pricing be flat over the next 3 years, essentially, because of this action by the Federal Reserve. I think it's pretty blatant and simple the way this works. I don't want to oversimplify it, though, because there's so many more factors at play. A big factor that's also at play is, and we've got to recognize this, is there is a housing shortage. We have about a 5 million home housing shortage. That is, we need 5 million more homes. I think we created somewhere around 12 million new households. And we've only created about 7 million homes for those folks in that same time frame. That's a huge shortage. And housing and construction are very slow. Building permits are very slow. It's impossible to build in California. It's obviously not impossible, but California is hugely failing at providing more homes, but you're having the same issue throughout the country. You've got input cost inflation for materials for building. You've got a labor shortage. You know, who's graduating high school today going, hey, I want to be a contractor? Not as many as people who want to be, programmers or maybe salespeople. Right? So you've got big issues in how much housing stock we have. And that lack of housing is what gives us our tailwind. That's what gives us that potential 3% or 4% appreciation per year. But you can see with the Federal Reserve's actions here, we are going to have some issues coming to real estate pricing. And it's just better to know that now. And personally, I think, hey, if you can start refinancing some properties to lower interest rates now's probably the time to do that. Worth mentioning. So you want to refinance, I'd recommend doing that sooner rather than later. Anyway, folks, thank you so much for watching this video. If you found this helpful, consider subscribing to the channel and check out the programs linked down below on building your wealth, including programs on property management and real estate investing. And folks, we will see you in the next one. Goodbye.